right, welcome. Today we're diving into Nam Cheong, an offshore services company that a lot of analysts are buzzing about. They're saying it's about to unlock a new cycle. And from where I'm sitting, the case for this stock is just incredibly strong.
Whoa, hold on a second, Alex. The risks are just as strong. We're talking about a classic cyclical industry here with a history that's, well, all over the place. So the real question for anyone listening is that potential reward really worth the gamble? And that's exactly what we're here to debate.
Look, on the one hand, you've got a company that's basically teed up for a huge comeback. They have a modern fleet, and they've already got new contracts in the pipeline.
But on the flip side, you've got some serious storm clouds gathering that you just can't pretend aren't there. So let's get into it.
Okay, so first things first, before we get into the debate, let's get a handle on what Nam Cheong even does. What are we actually talking about here? Right. So their bread and butter is chartering out these things called OSVs. That stands for offshore support vessels. You can think of them as the really crucial workhorses of the offshore oil and gas industry. Their main playgrounds are Malaysia and the Middle East. And this is where it gets really interesting right off the bat. Take a look at their fleet. The average age is just under 9 years. Now, that might not sound wild, but the global average is way up there at 16, maybe even 18 years old. That is a massive, massive competitive advantage. We're talking lower fuel costs, less time in the repair shop, and basically, they've got the shiny new toys everyone wants to rent. All right, so let's really dig into why I'm optimistic here. The bull case for me is just staring you right in the face when you look at the numbers. First, check this out. 1.7 billion ringgit in new long-term contracts. And that's just since the beginning of 2024. That is huge. What that means for an investor is you can actually see where the money's going to come from. It's not just a guess, it's locked in. We call that earnings visibility, and it's a beautiful thing. And I know we just talked about this, but it's so important we have to hit it again. That 9-year average fleet age. In an industry where your ships are literally everything, having a young fleet is like having a secret weapon. It means you're just more efficient, cheaper to run, and way more competitive than the guys with old, creaky boats. And here's the kicker, the number that really matters for anyone thinking about investing. The pros, the analysts, are looking at this and seeing a potential upside of over 57% from where it's trading now. Come on, that's a number that makes you sit up and pay attention.
Okay, Alex, that is a beautiful story you're painting, but it kind of ignores the elephant in the room, doesn't it? This industry goes up and down like a yo-yo. And you absolutely have to look at the history to understand the kind of risk we're talking about.
So a lot of the excitement that Alex is talking about, it comes down to this idea of a new build upcycle. The hope is that companies are going to start ordering a bunch of new ships again, and Nam Cheong will be right there, ready to build them.
But just take a look at this chart. Look at what happened last time. The market completely fell off a cliff. They went from delivering 24 vessels in 2014 to pretty much nothing just 2 years later. And this new upcycle that everyone's so hyped about, it's starting from zero. They haven't made a single dime from building ships for other people since 2020. To me, that's not a trend. That's a gamble.
And you know what? You don't have to take my word for it. The very same analyst reports that have everyone excited also point out these exact risks. Everything, and I mean everything, depends on big oil companies continuing to spend money. And it depends on Nam Cheong actually winning those new deals. If either of those things wobbles, that whole bull case could fall apart pretty fast.
Okay, those are fair points, Ben, I'll give you that. But this brings us to what might be the most interesting part of the whole debate. What is all of this actually worth? Let's talk valuation. So if you strip out all the one-off items and just look at their core profit, what the business is really making, it's called core PTMI, you see this really nice, steady growth. We're talking a forecast of almost 12% a year, every year through 2027. That's the sign of a healthy, growing business.
But hang on, look at the actual revenue. The top line. It's forecast to drop by more than 12% in 2025. And the reported profit, the number that includes all that noise you want to strip out, it is bouncing all over the map. So as an investor, you have to ask yourself, which story do you believe? The smooth, neat one, or the messy, real one?
Well, that's where their strategy comes in. And frankly, it's a smart one. They're cleaning house, they're selling off some older vessels, using that cash to pay down debt, and getting their balance sheet ready for new growth. And look at the result. Their debt level, what we call net gearing, is projected to plummet from 56% down to a super healthy 12% by 2027. That is just textbook good management.
Or you could call it a necessary trade-off. They're not selling junk, they're selling ships that are making them money right now. The report says those sales are going to cost them 40 million ringgits in revenue in 2026 alone. So let's be clear, they are giving up cold, hard cash today in the hope that this shipbuilding thing pays off tomorrow.
But Ben, this right here, this slide is the whole ball game. This is why it's so compelling. Nam Cheong is cheap. You can buy into this company at a price-to-earnings ratio of around 7. Its competitors, they're trading at over 11 on average. That is a 35% discount. You're getting a younger fleet and what I think is a much clearer growth plan, for less. It seems like a bargain hiding in plain sight.
Or maybe it's cheap for a reason, Alex. Maybe that discount isn't a bargain, maybe it's a warning label. The market sees all the risks we've been talking about. The volatility, the fact that they're betting the farm on a shipbuilding cycle that hasn't even started yet. So the real question isn't, is it cheap? The real question is it cheap enough to be worth the risk?
Okay, so we've thrown a lot of numbers and a lot of arguments at you. Let's just step back and boil it all down. For anyone thinking about this, what are the key things you really need to be watching? For the bulls out there, it's all about watching for these positive signs, these catalysts. If those new ship orders start rolling in faster than expected, if they can keep their boats busy, or hey, if they start paying a dividend again, any of those things could send the stocks significantly higher.
And for the bears, you're watching the other side of that coin. You're monitoring the risks. Keep a very close eye on what the big oil companies are doing. If they start cutting back on spending, or if there are any delays getting that new shipyard up and running, well, that would prove the market's worries were right all along.
So yeah, ultimately, it all comes back to that one central question we kicked this whole thing off with.
And that's a decision that, in the end, every single investor has to make for themselves.
Just so we're all clear, this content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.